The finale, signed, sealed, delivered. This is it. The one big beautiful bill is officially law. President Trump signed it on the 4th of July, because of course he did. While the name didn't survive the Senate reconciliation rules, the core business provisions did. So if you're a business owner wondering what's actually in this thing, we're about to break down the wins, the sneaky costs, and what to watch next. Bonus depreciation 100% is back. We're starting with the big one. Bonus depreciation is back permanently. For any qualifying property acquired after January 19th, 2025, you get 100% expensing in year one. This is a massive win for businesses investing in equipment, vehicles, software, you name it. And since the bill is already law, it's time to start thinking strategically about any major purchases you're planning for the rest of the year. This isn't just a future planning tool, it's in effect right now. Section 199A, the qualified business income deduction, locked in. The qualified business income deduction, yes, the 20% off the top for pass-through income is permanent. Section 199A is no longer on the chopping block. Even better, the bill expands who qualifies. But here's the catch. Those expansions add complexity. If you're an S corporation, partnership, or even a high-earning sole proprietor, it's time to get serious about structure and compensation strategies. R&D deduction, retroactive and revived. We're done pretending R&D should be amortized. The law reinstates the ability to fully deduct domestic research expenses, and you can go back to 2022 if you're a small business with under $31 million in gross receipts. But here's the key distinction. This is about US-based R&D only. Foreign research still needs to be amortized under existing rules. The incentive is clearly aimed at bringing innovation back home. If you've already taken the R&D credit and capitalized your R&D expenses in prior years, this is your chance to go back, amend those tax returns, and claim big refunds. It's real money on the table for businesses who've been investing in development the right way. Section 1202 adjustments, a new angle and tax-free exits. Big upgrade here. Section 1202 got a facelift. For qualified small business stock acquired after July 4th, 2025, there's a new tiered gain exclusion. That's 50% after 3 years, 75% after 4, and 100% at 5 or more. That's a game changer if you're aiming for a partial exit before the 5-year mark. Even better, the per issuer gain exclusion cap jumps from $10 million to $15 million indexed for inflation. And more companies now qualified for QSBS status thanks to a raised gross asset ceiling, $75 million instead of $50 million. So what exactly is a qualified small business? It's typically a US-based C corporation with less than $75 million in gross receipts after funding, and it must actively operate a real business, not just hold investments, and also not be service-based. These changes will likely make C corporations a more attractive choice for founders and investors. If you've already defaulted to S corps, now's the time to rerun the math. The gap between tax efficiency and tax-free exit just narrowed considerably. SALT deductions temporarily lifted, partially. The SALT deduction cap just got a temporary makeover. From 2025 through 2029, the limit rises to $40,000 if you itemize. But it's not a free pass. If your modified adjusted gross income exceeds $500,000, that cap phases down fast to the floor of $10,000. Now, that phase out creeps up each year with inflation, but this is basically how it works. If your AGI crosses $600,000, your deduction is back to the baseline $10,000. And starting in 2030, that baseline becomes permanent again. So if you're in a high tax state, there's a short-term window of opportunity, but it's not as generous as it looks at first glance. Importantly, the new law preserves taxpayers' ability to bypass the SALT cap using pass-through entity tax elections. If you own a partnership or S corporation and your state offers PTET, you may still get a full federal deduction at the entity level. And for those of us in California, we'll be watching closely to see if the state extends its elective PTET law to remain aligned with the feds. This could remain a powerful planning lever if done right. That wraps up the series. The One Big Beautiful Bill is officially law, and we've covered the most impactful provisions for business owners and individuals alike. But this isn't the full story. There's a lot more in the legislation than we had time to go into here. If you want to understand how this affects you, your family, your business, schedule a risk-free consultation by heading over to www.tandvllp.com/tax-planning, and let's walk through it together.